In 1929, a single microscopic organism threatened to wipe out the world's entire coffee supply, and the economic collapse that followed had nothing to do with Wall Street. The crash of October 1929 is remembered as the moment the stock market collapsed. But 3,000 miles away, in the coffee plantations of Ceylon, modern-day Sri Lanka, a different kind of catastrophe was already unfolding. A fungal disease called Hemileia vastatrix, or leaf rust, had infiltrated the island's coffee crops. And here's the trick: the economic dominoes that fell because of it tell us far more about how global supply chains worked in the 1920s than any graph of the Dow Jones ever could. Let's start with the money flow. In 1920, Ceylon produced roughly 100,000 tons of coffee annually. That coffee moved through a specific financial pipeline. Plantation owners sold to local merchants, merchants sold to exporters, exporters sold to British trading houses in London, and those houses distributed to roasters and wholesalers across Europe and North America. Every transaction added a margin. Every margin meant profit flowing back up the chain. The fungus didn't care about profit margins. Leaf rust spreads through moisture and spores. It turns coffee leaves brown, then kills them. Once infected, a plant stops producing. By 1928, the disease had spread across most of Ceylon's growing regions. Yields collapsed. Within 2 years, production had dropped to roughly 30,000 tons. That's a 70% loss in a single commodity that fed an entire economic ecosystem. Now trace the money. Plantation owners who'd counted on annual revenue suddenly had nothing to sell. They couldn't pay workers, they couldn't service loans. The local merchants who bought their coffee had inventory they couldn't move. The exporters had no product to ship. And the British trading houses in London, they lost their supply line entirely. But here's where it gets interesting. Ceylon wasn't the only major coffee producer. Brazil produced coffee too, lots of it. In fact, Brazil had been increasing production throughout the 1920s. They'd planted millions of new trees, betting that global demand would keep rising forever. And global demand had been rising. But here's the trick. When Ceylon's supply evaporated, Brazil suddenly flooded the market with their own surplus. Prices collapsed. A commodity that had cost money suddenly cost almost nothing. Brazilian plantation owners, who'd borrowed heavily to expand, watched their revenue vanish. They'd taken loans against future harvests. Those loans came due regardless. Banks that had financed coffee expansion started failing. Agricultural credit networks seized up. Small farmers went bankrupt. Large estates were seized by creditors. And the financial shock radiated outward through South American economies that depended on coffee export revenue. But the supply chain story doesn't end in Brazil or Ceylon. It reaches London, New York, and every port city in between. Traders who'd bought coffee futures contracts, bets on future prices, were suddenly holding assets worth a fraction of what they'd paid. Insurance companies that had underwritten shipping contracts faced massive claims. Roasters who'd stockpiled inventory at higher prices were sitting on losses. The broader question becomes, how much did the fungus actually cost the global economy? Direct losses in Ceylon alone: lost wages, lost harvests, bankruptcies, ran into tens of millions of pounds. That's roughly $1 billion in modern terms. But the indirect costs multiplied through the financial system. Banks that had lent to coffee operations faced defaults. Credit dried up across agriculture. And in an economy already fragile from overspeculation, every crack matters. The timing is crucial. The coffee crisis hit in 1928 and 1929, the exact moment the stock market was reaching its peak. Investors had been pouring money into everything: stocks, real estate, commodities. The coffee collapse showed that even fundamental commodities, things people actually needed, could vanish overnight. It was a warning sign nobody heeded. The psychological impact was real. If coffee could fail, what else could? Here's what makes this a forensic accounting story rather than just agricultural history. The fungus didn't cause the Great Depression, but it exposed how fragile global supply chains actually were. One organism, one crop failure rippled through 3 continents and destabilized financial systems that were already leveraged to the breaking point. The money was real, the losses were real, the fear was real. By the 1930s, Ceylon's coffee industry had essentially ceased to exist. The island pivoted to tea production instead, a crop that turned out to be far more profitable and resilient. Brazil eventually recovered, but only after years of government intervention and price support schemes that cost millions. The fungus itself never disappeared. It's still present in coffee-growing regions today, but modern fungicides and resistant plant varieties keep it in check. So here's where we land. A microscopic fungus nearly destroyed the world's coffee supply, not because the fungus was particularly ambitious, but because the global economy had built a supply chain with no redundancy and no buffer. One region failed and the entire system convulsed. The money that disappeared, billions in today's terms, was real. The jobs that vanished were real. The fear that spread through financial markets was real. And it all started with a single organism on a single leaf. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe. There's a new economic story buried in history every week, and they're waiting for you. Subscribe. There's a new economic story buried in history every week, and they're waiting for you. This video is for educational and informational purposes only and is not financial advice. Always do your own research.